When you use your crypto, you probably think of it as one action, but what if the IRS sees two? In this explainer, we're doing a deep dive into the tax rules for digital assets, and we're going to focus on one particular trap that can, believe it or not, leave you with a massive tax bill even when you've lost money.
Okay, so here's our roadmap. We're going to start with the absolute foundational principle the IRS uses. Then we'll build on that by looking at the key laws and regulations. And finally, we'll see how it all comes together with the new rules. And, of course, that really surprising tax trap I mentioned.
All right, let's kick things off with the single most important concept you have to understand. The IRS decided that digital assets are property. This isn't just a small detail. It is the absolute bedrock of the entire U.S. tax structure for this entire asset class. Everything flows from this one decision.
So what does that actually mean for you? Well, it means that every single time you dispose of a digital asset, whether you're selling it, trading it for another crypto, or even just using it to buy a cup of coffee, it is a potentially taxable event. This creates a huge and frankly often overlooked compliance burden for anyone and everyone in this space.
Okay, so if pretty much every transaction is taxable, how on earth do you figure out the gain or loss? It all starts with a number called your cost basis. That's basically what the asset was worth when you first got it. And let me tell you, getting this number right is absolutely critical.
You know, people get their hands on digital assets in a whole bunch of different ways. Buying with good old-fashioned dollars is the most straightforward, of course, but receiving assets from things like mining and staking, or even getting paid for your work in crypto, well, those have immediate tax consequences the moment they hit your wallet.
You can see a really clear pattern here, right? Buying with cash is simple, not a taxable event. But look at almost everything else: mining, staking, getting new coins from a hard fork, or being paid in crypto. In all those cases, you have to recognize the asset's fair market value as ordinary income the second you get it. And that value becomes your cost basis, your starting point.
And this is the key. That cost basis isn't just some number you can estimate. It is the foundational variable for every single future calculation. Every unit of crypto you own has its own unique basis, and you have to be able to track it meticulously.
All right, let's get into the weeds a bit and look at the specific statute that governs every single one of these dispositions. When it comes to taxing property, pretty much all roads lead back to this one powerful section of the Internal Revenue Code.
And that section is IRC Section 10001. If you're serious about this space, you need to know it. This part of the tax code dictates how you determine and recognize a gain or a loss whenever you sell, trade, or exchange property. It's the engine driving the whole system for digital assets.
And you know, the formula at the heart of Section 1001 is actually pretty simple. But don't let that fool you. It's incredibly powerful. Your taxable gain or loss is just the amount realized, which is what you got for the asset, minus your adjusted basis, what it cost you in the first place. This calculation is at the core of every single disposition. Period.
Now, you might be wondering about crypto-to-crypto trades. While a landmark Supreme Court case called Cottage Savings provides the legal justification for why those are taxable, the key phrase to focus on is materially different. The IRS has made it very clear that different cryptocurrencies easily meet the standard.
I mean, just look at Bitcoin versus Ethereum. They run on completely separate ledgers, use different protocols. They are, without a doubt, materially different. So exchanging one for the other is always a taxable event. And I have to stress this. The like-kind exchange rule that you might have heard of for real estate, forget about it. It absolutely does not apply to digital assets.
So, we have this foundation. Crypto is property. Now, let's talk about what's new, because Congress and the Treasury have just rolled out a massive, sweeping new compliance regime. It's specifically designed to close the information gap that's existed in the crypto world for years.
And this didn't just happen overnight. You can see the deliberate process here. It started back in 2021 with the Infrastructure Act. That laid the legal groundwork. Then, in 2024, the Treasury released the final regulations. That's the detailed rulebook. And the key date for everyone to remember is January 1st, 2025. That's when it all goes into full effect. A huge part of these new rules is this brand new, very broad definition of a digital asset. They wrote it this way on purpose. By focusing on the underlying tech, the cryptographically secured distributed ledger, it's designed to capture everything that exists now and anything that might be invented in the future. So yes, that includes NFTs and pretty much anything else you can think of.
Okay, now that we have all the pieces, crypto is property, and new, strict rules are coming,
Let's put it all together and look at a scenario where things can get really, really messy. I'm talking about using crypto for wagering. This is where the consequences of that property classification can be severe.
So here is the really mind-bending part. When you place a bet with crypto, the IRS doesn't see one single action. They legally split it into two completely separate events, and each one is governed by its own set of tax rules. This split, this bifurcation, is exactly where the tax trap is set.
This is the part you absolutely have to understand. From your point of view, you're just placing a bet. But in the eyes of the law, the instant you transfer that crypto to the wagering platform, you have sold it. Transaction 1 is now complete. Your capital gain is calculated and locked in right then and there. What happens with your wager after that, it has zero impact on this first transaction. Let's put some real numbers to this to see just how painful it can be. Let's say you bought some crypto for $500. Later on, it's appreciated and is now worth $5,000. You decide to use that to place a bet. Boom. The moment you make that transfer, you have an amount realized of $5,000 and a basis of $500. That creates an immediate, taxable capital gain of $4,500.
And here is the absolute gut punch. Now let's say you lose that $5,000 bet. You'd think, okay, I lost $5,000, but I had a $4,500 gain, so they should cancel each other out, right? Wrong. A wagering loss under IRC Section 165D can only be used to offset wagering winnings. You cannot use it to offset a capital gain. So you can be out your entire $5,000, have an overall economic loss, and still owe the government tax on that $4,500 phantom gain. It's a brutal asymmetry.
This table lays it out perfectly. You've got two completely separate legal tracks. Phase 1, just funding the bet, falls under Section 1001, property rules. That's your capital gain. Phase 2, the outcome of the bet, is totally separate. A win is ordinary income under Section 61. A loss is a wagering loss with the very strict limitations of Section 165D.
Okay, finally, let's cover the new non-negotiable rules for identifying and tracking your assets. This is a huge part of the 2024 regulations. How you identify which specific units of crypto you're selling is no longer up for debate. It is now strictly defined by the IRS.
Essentially, the rules are different depending on where you keep your assets. If they're on an exchange, what they call a hosted wallet, the default method is FIFO, or first in, first out. That means the first coins you bought are considered the first ones you sold. But if you're holding them yourself in an unhosted wallet, you must use specific identification. And that means you better have meticulous records to prove exactly which units you sold and when.
So this all leads to the one critical question you should be asking yourself. The era of vague reporting and best guess accounting is officially over. It's being replaced by a highly surveilled automated system. The Two-Transaction Liability and these strict new ID rules demand a level of precision we haven't seen before. So, with that January 1st, 2025 date approaching fast, are you truly prepared for this new era of enforcement?